got Guy LeBas, Janney Montgomery Scott, head of fixed income, along with Luke Tilley, Wilmington Trust chief economist and former Philadelphia Fed economic advisor. Luke, I'm going to start with you here because you are still expecting a pretty steady trajectory of cuts next year. Is the dot plot changing your outlook on that front?
No, I don't think so. I think that the members of the FOMC are rightly a little bit cautious about inflation given the numbers that we've gotten, but I think they're a little bit too sanguine about the labor market. The labor market has slowed significantly. If you look through all of these storms, private non-farm payroll growth is now just 108,000 on average over the past 6 months. And you also have labor demand falling precipitously. So I think that the labor market is going to end up having them cut faster than even they are saying today. And we're expecting those rate cuts to come through until September of next year, at every meeting until next year. And we'll be at neutral before we get to the end of 2025, Julie.
Guy, I want to bring you in here as well, get your quick response to the news, Guy. What the Fed did here is what you expected, Guy. Was it the right moves, in your opinion?
Well, I do my best not to judge whether the Fed is doing the right thing, because that makes them more likely they're going to miss whether we think they're doing what they're going to do. Poorly phrased, but you get the point. I think the sort of underlying story, and this is a little bit buried within the SEP, the economic forecasts, is if you take a look at the Fed's inflation expectations for 2025, the median of those expectations bumped up considerably, but the range actually shifted somewhat higher as well. So the central tendency expectation for core PCE inflation for 25 is now between 2.5% and 2.7%. And look, if that forecast comes to pass, which it's very, very hard to judge the inflation outlook 6 or 12 months hence, if that forecast comes to pass, I think 2 cuts is more likely to emerge than 3 or 4 or even more than that in 25.
And Guy, what effect does that then have on the bond market, right? Which is your bread and butter here, looking at what happens in fixed income. How is that going to affect? Because what are we seeing currently priced into fixed income?
Yeah, right now, or at least heading into the meeting this morning, there was round numbers about 3 cuts priced in 2025. And frankly, I don't think, and I want to separate put some distance between what I anticipate is likely to happen and what the markets are going to price. Because Luke's point a minute ago, the markets are going to continue to price some downside risk of economic slowdown. I'm just not convinced it emerges. So the markets are probably going to leave that pricing somewhere in that 3-ish cut range for 2025, even after this announcement. And I don't think Powell is going to guide terribly different from that at his 2:30 press conference.
Luke, back to you. I'm just curious. They cut as expected. Luke, I'm wondering, what are the risks of doing a cut, in your opinion?
I don't think there's any risks of doing a cut right now. I think there's a risk that they're saying that they're not going to cut rates even more. So I understand that the inflation data has stalled out a little bit, but if you just separate the shelter component and look at all other components of inflation, the Fed has already been at target for about 18 months, whether you're looking at PCE or CPI. It's really just that shelter component that is keeping things high, and we know the lags from market rents. So right now, consumers are not really in any kind of position to keep inflation accelerating. And with the labor market worsening, I think that that they need to end up revising downwards here and be cutting more because the risk is that they are too tight for too long. Real yields are still very high compared to the past 10 or 12 years. And it's putting a pretty solid brake on the economy right now. And that's the real risk, Josh.
Luke, it's really interesting because I think fair to say the consensus is not where you are right now, right? And it seems like the crowd has sort of looked at the past couple of years and said, we kept underestimating growth. We're not going to make that mistake again. Do you think that is the wrong lesson to take away right now? We're sort of fighting the last war, if you will?
Yeah, I do think it is the wrong lesson because the real lesson to take is even when growth is strong, inflation has been coming down. That was the real mistake of 2023, is not realizing that inflation could come down. That's coming from companies getting more productive, from people joining the labor force. And I expect that now we're going to have the economy slowing down and inflation will keep coming down. And that's why I think the Fed will end up cutting a lot more than they're saying today.
Guy, what did you make of the argument? I did hear some making this, which they should have paused here, Guy, because the fiscal policy outlook is so uncertain with Trump moving back into the White House, taxes, regulation, tariffs, immigration, so unclear right now, Guy. That's why they should have held off. What's your response to that line of thinking?
Yeah, I mean, to borrow a phrase from Lael Brainerd, when in a dark room, move slowly. You don't want to bark your shit on the coffee table, which I guess the coffee table is an economic slowdown in this case. But the point being that with an uncertain outlook, the natural tendency is to move the trajectory of interest rate changes a little bit more gradually. And I don't see a lot of downside to that right now. Now, Luke, I know you made the argument that labor activity is slowing considerably. It doesn't strike me as an immediate problem, certainly not one that's going to be resolved with aggressive downside action in the interest rate markets, not in the very short term. I suspect really what we're going to see is just in response to the potential fiscal changes in 2025, most of which will hit in late 25. In response to those changes, the Fed's just going to act more gradually rather than more aggressively. And today is sort of the last, in my expectation, of the consistent 25s at every meeting. And we'll probably slow down in early 25 to perhaps 1.25, perhaps just 2 for the full year. And that's that gradualism that I mentioned a moment ago.